Many people would have said needed to happen in this market. Apple, Microsoft, Nvidia, all more than 10% from their highs, and yet the overall S&P
needing that good old decline, that good old reset. And you know what? That may be true, but there's also some potential fear that the Federal Reserve is going, well, overboard. And that's what's giving the bears the strongest potential recession narrative right now. In fact, there are some arguing that right now, inflation is basically gone. Yet the Fed has raised rates over 550 basis points, 5.5%. Take a look at Jay Parsons, who puts together a really great thread on Twitter. Jay Parsons says the following: inflation is basically gone when you exclude the lagged shelter index in CPI. Remember, rent is one of the biggest variables in the CPI basket category, and there's about a 12-month lag between rents and CPI. Now, this is really important. So there are two things he's setting up here, right? And then we'll talk about how the Fed is potentially screwing things up. He's setting up two things. Number one, he's telling you, look, inflation is essentially trending towards zero, but you have to remove the shelter component. And this frustrates a lot of people because people say, well, come on, man, like housing is a big portion of what people spend money on. 30 to 40% is usually your housing ratio. For those mortgage lenders out there, your good old front end ratio. And so removing that seems kind of rigged. But the reason people remove it is because the government uses this lagged measure of trying to understand what rents are, known as owner's equivalent rents, which is basically what do owners think they could rent their home out for in surveys. Well, rents could go up, and then it takes homeowners a long time to actually realize what rents are, as lease turnovers take time. And so this gives you a really bad measure of what actual rental inflation is. Redfin gave us a much better indicator. They say that year over year from this July, so basically last month, to last August, so an 11-month comparison, rents are actually on average negative $16. So that actually means prices fell over the last 11 months, which let's just assume they're flat August to August. That means your rental inflation is actually zero. But the government says rental inflation is actually around 5 to 6% annualized. That's when you take that 0.4 or 0.5 number and multiply it by 12. And that's really frustrating, folks, because that's leading a lot of folks to say the Fed is going to drive us into a recession because they're looking at lagging data. And this lagging data is going to leave the Fed keeping rates higher for longer. And that could end up crushing our economy, which obviously isn't good. Let's keep looking at what Jay says here, and then we'll go into some of the latest data. So Mr. Parsons here goes on to say, I'm surprised about how little buzz there is about this inflation decline to basically nothingness outside of the econ or finance community. This, like inflation right now, less shelter, is sitting at just 1% year over year, the lowest number since November of 2020. It's less than half of the 20-year average. Meanwhile, CPI rent inflation continues to slowly cool as expected, following its predestined down ramp based on asking rents that have been moderating since the spring of 2022. CPI rent inflation measured 0.41 month over month, the lowest read since December 2021. Year over year, though, CPI rents up 8%, marking 4 months of cooling after 20-month ascension. Okay, some detailed numbers here on top of what I've just outlined. And so as these asking rents continue to cool, we actually start wondering what happens to inflation when these rents go potentially flat or negative. This is what I argued in a tweet myself yesterday, where I said we could be looking at deflation solely because of rents going negative and dragging the entire index down. Think about this. The year-over-year CPI read was 3.3%, in the CPI read we got yesterday on Lauren's birthday. Well, what was the main contributor to that? Well, housing. 90% of it was contributed by housing. Well, imagine now, if we take out that 90%, right? If we were to go oversimplifying here, but if we go 3.3 times 0.1, we really only saw 0.33% year-over-year inflation outside of that housing contribution, right? But imagine now if housing via rents were even, let's say, down 1%. And so you got a zero point 0.9 weight to the downside with no upside contributor to inflation. You could potentially be not just below 2%, but below zero with housing disinflation. Now, I'm not suspecting that we're actually going to get to that because I think other prices might end up continuing to rise. And obviously, we're still dealing with really high prices, right? Rents still feel high. And that's important to know is just because the inflation rate is falling doesn't mean prices are coming down. People get this wrong every time. They hear me talking about inflation going to zero and they're like, why are prices still so high? Well, that's because they went up and then they're flat. And when you go up and you're flat, you're still really expensive, but the inflation rate is technically zero. And there's obviously a big misunderstanding about that. But anyway, this idea about this lagged shelter data, even though the Fed implies that they're aware of it, has a lot of people scratching their heads and going, this Fed is going to drive us into a recession. Look, for example, what Marie Daly mentioned yesterday. Here's Bloomberg quoting her when Bloomberg suggests markets were fragile yesterday after San Francisco Reserve Bank President Mary Daly said the Fed, quote, still has more work to do to combat rising prices, dampening the impact of broadly positive inflation data on Thursday. Now, that was very frustrating to markets. In fact, you don't even have to look too closely at the markets. If you even remotely looked at markets yesterday, you were probably like, what the hell just happened? Because look at, for example, the NASDAQ yesterday. After we got our CPI report yesterday on the NASDAQ actually returned to another fib level, right around 374. It rallied out of the gate, much like many stocks did. But stocks broadly sold off throughout the rest of the day and held lows throughout the rest of the day following Mary Daly's comments. And this is because people are worried that this Fed might legitimately overdo it and drive us straight into a recession. And this makes sense because think about how slow they were to react to what initially was just thought to be, oh, it'll just be a transitory little bump of inflation. But we printed so much money so rapidly, we ended up getting a very large explosion of inflation, to which obviously the Fed reacted very slowly. The Fed was still printing money in March of 2022 when we had over 7% inflation, which was just nutty. But anyway, they're slow to react on that side. Now people think they're going to be slow to react on the other side. To some extent, break-evens are relatively stable. Break-evens are a tool that I like to use to evaluate what the market thinks about inflation. 5-year break-even rate sitting at 2.27. That assumes that inflation is going to be an average of 2.27% for the next 5 years. That's pretty close to target. The 5-year forward level is coming back down, normalizing rapidly from this really bizarre spike we had over the last week. So I'm going to keep an eye on that, but not make any conclusions there. The terminal Fed funds rate is currently expected to be 5.37%, which is basically where we are now, with less than an 8% chance of us actually getting a hike from the Fed going into the September meeting. We are expecting that our first cuts will come from the Fed as early as January 2024. That is the first time we have any implied rate cuts. And then we are looking at about 1% of rate cuts as soon as November of 2024. So starting somewhere Jan, March, May, getting all the way to about 1% of cuts around the election time, which won't that be quite convenient? That there'll be potentially massive interest rate cuts by the time we get to the election. And unfortunately, if the Fed continues to behave the way it does with this Fed speak, where it's like, oh yeah, okay, yeah, inflation's coming in good, yeah, that's fine. We still have more work to do. The more the Fed pulls that off, the more likely it is that we're going to get pretty substantial rate cuts come the time of the election, because the Fed will really have risked overdoing it, and we might actually end up seeing unemployment rise substantially more than expected. And that's actually a big problem. In fact, some of where you're seeing the highest unemployment right now is in a pretty surprising place. I'll talk about that in just a moment. I just want to remind you that we just launched a new feature where you can go to StackHack, STACK, hack, like get stacked, go to stackhack.com and you can actually get licensed financial advice. We're in a pre-sale right now. We've already had a lot of people sign up and there's a capacity to how many can sign up. We're getting started with work on these signups next week. That's when we'll end the pre-sale and we'll actually be able to start working with everybody. But we're offering actual financial advice, which is pretty cool. We've got a team of financial advisors, all licensed, which is super exciting. And then we can actually review your personal portfolio, your personal situation, and give you some real feedback on, well, here's maybe what you could do in your situation, as you, like incorporating all of your own information, which is pretty exciting. If you're looking for more principles to building wealth, of course, you still have the programs on building your wealth, a link down below as well. That would be at meetkevin.com. Okay, so what segment of our economy right now is seeing the largest level of unemployment? Well, you might be surprised by this, but it's actually the income groups making more than $125,000 per year. That's kind of scary to economists because they look and go, wait a minute, high inflation was supposed to affect poor individuals more. That's how everything's rigged against poor folks, is inflation supposed to hurt the lower income folks. But it's actually the higher income folks who are ending up with more credit card debt, lower wage increases, and more unemployment and layoffs. All of this combined leads to potentially more of a recession, as some people are calling it, and this reality that the Fed may completely end up overdoing it. So we'll see, but it's one of the reasons, or in other words, one of the reasons I should say, that we're seeing Treasury yields so elevated at the moment, and actually rising today. Good Lord, it's kind of remarkable. 10-year Treasury back to about 4.11. What you have is people with this impression that, okay, well, if the Fed is going to overdo it with this higher for longer nonsense, even though inflation has basically gone to zero, well, then we may as well keep selling off treasuries because the Fed will keep jacking up rates, ignoring economic data and pain. That's really the bear bet right now. The bear bet isn't, oh, inflation is going to be here forever and we're going to get Paul Volckered. That was last year's bear bet. Today's bear bet is the Fed's blind to inflation being gone and the pain that they're actually creating, as well as the lagged effects of their policy as they're driving this bus, looking in the rearview mirror, looking at inflation reports, to which 90% of the inflation reports are propped up by CPI data that is 12 months old. Owner's equivalent rents and shelter inflation. It's pretty nutty. So anyway, that's leading to a lot of fear. Obviously, there's some geopolitical, updates regarding Biden and China, and some economists saying he's not doing enough, others saying he's doing too much, China's economy slowing down, all this nonsense. All this, by the way, doesn't seem to be affecting oil prices at all, because take a look at this. Even with China's economy and sort of somewhat of the doldrums right now, you still have international oil at $87 a barrel. That's relatively high. WTI, the Western blend, sitting at about 83, much higher than the 69 we were used to there for a while. Zoom out on the 5-year, and if you look at the 5-year chart for Brent crude, and you remove 2022 from like Jan 2022, when that invasion was really threatened in Ukraine, all the way to about November, if you remove that hump, we are at the highest level of oil prices in the last 5 years. In fact, why don't we just zoom out a little bit more? The last time we saw oil at these levels before this, 2022 Ukraine madness was in that 2013 to 2014 oil crisis cycle, which is quite remarkable, especially since a lot of economies are really slowing down right now. Seems kind of like the opposite of what should be happening. But then again, we are seeing or hearing of more threatened supply constraints, purposefully designed by OPEC Plus to prop up the price of oil. All of these things just contribute potentially to more unemployment and more pain in the economy. And so I think it's potentially quite likely, and this is just my prognostication, so take it for what it is. It's an opinion, okay? We can have opinions. But my prognostication on this is that the Fed's rate cutting cycle will actually look a little bit extreme. I'm going to pull up a notepad here and kind of draw for you what I think. So what I think we're going to see is something where you end up with rates that have risen substantially to are about 5.5%. And then what you're, as sort of the upper bound. And then what I think we're going to see is this flat, right? So we might end up seeing, let's draw that a little straighter. There we go. So let's call that the July level. So we'll call that July 23. It would not shock me to see a Federal Reserve that keeps rates at 5.5 until July 2023. And here's the crazy part. You ready for this? Election season is really going to heat up. And I'm not like tinfoil hat here. I just think it's going to be oddly convenient how this aligns. Okay, ready for this? And mind you, I'm saying this here in August of 2023, so it could be wrong here, but this is how things are lining up with today's data. This is what I would be expecting. We sit at 5.5 all the way to July 2023. Now all of a sudden we start seeing unemployment rates rise, and then what do we see during this election cycle, which I'm going to draw, I guess I should draw that as, let's draw it as sort of like this box here. We'll call this little box here election cycle. Let's draw it like this. Yeah, there we go. We'll call that election cycle time, which would be your August of next year to November of next year, maybe even December of 2024. I think during this window, you're actually likely to see rates end up doing something like this, a dramatic plummet, to where you could see right before the election some kind of pretty wild -2%. Now, markets are not pricing that in right now. Markets are actually only pricing in -1%. But I think staying at this high level to just 100% make sure inflation is gone and the economy is nearly crushed will end up leading to a Fed that prefers rapid rate cuts, rapid and aggressive rate cuts. That's what I think. So, unfortunately, that means this higher for longer pain is likely to affect interest rate sensitive sectors more. And that's problematic. It's problematic for autos. It's problematic for solar. It's problematic for debtors. It's potentially also problematic for housing, that higher for longer pain. As soon as we get to that rapid decline in rates, though, all of these sectors will have massive tailwinds behind them. And so this is where a lot of people will say, okay, so are you saying we should buy autos, solar, and stuff like that, and have debt or whatever? Should we just buy those things in the summer of 2024 then? Right before potentially those rate cuts. And while that is theoretically a good idea, usually the stock market aggressively starts pricing in these sorts of rate cuts 9 to 12 months before they come, which actually means you would potentially hope to see some of this rate cutting priced in starting between November and maybe May of next year. Who knows? But it's something to consider. That's just my thesis. It's entirely possible that the Fed ends up stair-stepping rates down a little bit more, where you kind of slowly lower rates and you do end up getting that 1%. They slow walk rates down. But I don't think the Fed is going to do that. And I want to be very clear about why I think that. I think the Fed has worked so hard to get to this level, sitting in their pizza boardroom meetings and let's raise. Anyway, I think they've done what they can to get to this level. Now you're at this level, and now the goal is don't signal to the economy that we're just going to run the money printer again, because that would imply inflation expectations rise. And that's what they don't want. They don't want inflation expectations to de-anchor. Let inflation get low, and then you could rapidly cut when inflation expectations are low and inflation is low. When both of those are low, then you could rapidly cut. Now, that obviously introduces the other bear argument where people say, oh, but when the Federal Reserve is going to cut rates again, they're going to induce inflation. And this is something that I strongly disagree with. That's because if we look at the Fed balance sheet, how much money they actually have outstanding. I think one of the things that a lot of us forget is that we think very Austrian for a moment, and we think, okay, inflation, per the textbook is the expansion of the money supply. Fine. Maybe that is the textbook definition of inflation, the expansion of the money supply. Then let's just say consumer prices, okay? Consumer prices. How do consumer prices move when the money supply expands? Well, as long as the money supply expands gradually, consumer prices actually stay relatively stable. So from an Austrian point of view, you could expand the money supply and you're supposed to be creating inflation, but consumer prices don't actually move up. That is what we saw in the decade post the last crisis. Look over here. And sorry if I said 2023 where I meant 2024. I think you know what I mean. But anyway, this is what we saw with the Fed's balance sheet from 2009 all the way out to 2014. We saw the expansion of the money supply. We saw the leveling of the money supply. And we briefly saw a decline in the money supply. During this entire era right here, from the 2008 financial crisis, we actually didn't see very much inflation at all. In fact, the Fed was considering lowering their inflation target to 1.75% during this era. Well, it was the rapid expansion, that acceleration in the money supply, that led to the rapid inflation that we see now. Obviously, stimulus checks, helicopter money, all of that. This is a lot more logical. So I think when we look at the nuance of when the Fed cuts rates and the expansion of the money supply, we don't necessarily have to create inflation if we do it in sort of normalized ways. And we've seen rate cuts before not lead to substantial inflation or any inflation for that matter. So I'm not a believer that when the Federal Reserve finally rapidly cuts rates, that we're going to reinduce inflation. I think that'll be a story of the past. That's my opinion. It could be wrong. And if there's data to suggest it's important to flip-flop, well, I will make sure of that, or make sure to bring that flip to you. But for now, I'm pretty confident in, to the extent that you can be in any kind of prediction, I'm pretty confident that this is probably more the direction the Fed is likely to lean. And that could be frustrating for stocks in the nearer term. But personally, if you have an investment horizon that's more than a year, probably a good opportunity, though obviously that's not personalized financial advice for you because that depends on your situation. We can talk principles here or in my courses on building your wealth. But if you want actual financial advice, you should speak to a licensed financial advisor, like what's now available at stackhack.com, where myself and the team now offer licensed financial advice. Check that out at stackhack.com. We're in pre-sale right now, and we'll be helping people out very soon, probably next week, with actual financial advice. So we're very excited about that. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.